Okay. Guys, we have understood the finance lease part, right? If I sum up or summarize the entire finance lease part, what was the important points? Point number 1, lessor will be treated as a deemed seller. Lessor can be dealer or non-dealer. In both cases, lessor has to de-recognize the asset or book the sale. In both the cases, lessor has to be treated as deemed seller. Lessor has to recognize the lease receivable at present value of NIL always. What is the present value of NIL? That means, present value of GIL, that means NIL. What is GIL? All the lease payments plus GRV plus UGRV. Lessor will use the interest rate implicit in lease. Initial direct cost will be a part of interest rate implicit in lease if lessor is non-dealer. Initial direct cost will be directly charged to P&L if lessor is a dealer. The finance income has to be booked every year. The lease receivable account shall be reduced every year because of payments we are getting. That's fine. The initial profit on outright sale may be booked in case of dealer lessor. That will be the difference between COGS and sale. Sale will be calculated as lower of fair value or present value of MLP excluding UGRV. COGS will be carrying amount of PP, carrying amount of asset if any, minus present value of UGRV. That's it. This is the entire summary for lessor. Now,